I want to start today's deep dive with a specific and honestly somewhat terrifying concept from aviation. It is a state that pilots call being behind the power curve.
Right, which is a phrase that has definitely bled into corporate speak,
Right.
to mean just falling behind. But the literal aerodynamic meaning is much nastier than that.
Much nastier, yeah.
Ah,
It describes this very specific state of flight where you are flying low, you are flying slow, and you reach this critical angle of attack where the aerodynamic drag on the airframe is actually greater than the maximum power your engine can
so
produce.
you are physically incapable of climbing.
Exactly. The math just says you are going down.
And the really terrifying part is the physics of the recovery. Because to get your speed back, to get back in front of the curve, you actually have to push the nose down. You have to dive toward the ground to generate lift.
Which is the absolute last thing your brain wants to do when you are already skimming the pre-tops, right? It is this high-risk, completely counterintuitive maneuver just to survive. Now, we are talking about this today because we are looking at a massive piece of research that asks a pretty simple question. Do private equity managers do the exact same thing?
Right. When they are behind the curve, either underperforming on returns or running out of time to spend their capital, do they make rational, safe decisions? Or do they nosedive into risky behavior just to keep the fund alive?
To figure this out, we are diving into a dissertation. It is titled Behind the Curve, an analysis of the investment behavior of private equity funds by Deger, published in 2013. And I want to be clear about the scope here for you listening, because this isn't just a handful of anecdotes from a few nervous investors.
No, not at all. This is forensic accounting on a macro scale. Deger actually analyzed 1,190 buyout transactions across Europe and North America, and this spans from 1985 all the way to 2009. We are talking about a total transaction value of over 530 billion euros.
That is a €500 billion data set, which is enough volume to really smooth out the noise and show us the actual behavioral economics happening inside the deal room.
Exactly. The mission of our deep dive today is to see if investment pressure breaks the rational market model. Because we tend to view general partners, the GPs running these funds, as these masters of the universe. Cold, calculating, purely rational.
But this data suggests that when the clock is ticking or when they are losing, they might be just as prone to panic as a pilot in a stall.
And the consequences of that panic are incredibly expensive.
Yeah.
But before we get to the behavioral failures, we really need to strip down the engine. We need to agree on the mechanics of the machine they are operating. We are talking about leveraged buyouts or LBOs.
Right. Give us a quick refresher on that because it is the engine for all of this.
Sure. At its core, an LBO is a simple mechanism. A private equity firm identifies a target company. They create a new co, which is just a special purpose vehicle. They put in a relatively small amount of equity, which is money from their investors, and they borrow a massive amount of cash from a bank to cover the rest of the purchase price.
And the target company itself acts as the collateral.
Yep.
It is sort of like buying a rental property and taking out a mortgage based on the future rent, not your own salary.
Correct. But the crucial part, the part that drives the behavior we're going to unpack, is the philosophy behind that debt. For a long time, the prevailing wisdom in finance, going back to Michael Jensen in 1989, was that this massive debt load is actually a feature, not a bug.
Right. Jensen called it a disciplining force.
He did. The theory is that corporate managers, if left alone with a profitable company and no debt, get lazy or wasteful. They accumulate free cash flow and spend it on corporate jets, plush offices, or empire-building acquisitions that don't actually make money.
They basically treat the company account like a personal piggy bank because there is no immediate penalty for wasting cash.
Exactly. But if you load the company up with debt, suddenly that free cash flow has to go to interest payments. It forces management to cut the fat, optimize operations, and run lean just to keep the lights on.
So the debt effectively straps the CEO to the mast. It forces efficiency because the alternative is default.
That is the agency theory of LBOs. And to be fair, the data actually backs it up to an extent. While LBOs are financially fragile, they file for bankruptcy less often than comparable public companies.
Which seems completely counterintuitive given the huge debt load.
It is because the private equity investors act as a backstop. If push comes to shove, the PE firm can inject more cash to save the ship, whereas a public company might just dissolve. But that is the ideal scenario. That is when everyone is acting rationally to maximize the value of the company. Deger's research pivots to the darker side.
Right, because he is not looking at the incentives of the company managers. He is looking at the incentives of the fund managers themselves, the GPs.
Yes, this is the principal agent conflict. The investors, the limited partners or LPs, they put up the money, the GPs make the decisions, and their interests are not always aligned. In fact, under pressure, they often diverge completely.
To understand why that happens, we have to look at the waterfall.
The payment hierarchy, it usually works like this. First, the GPs get a management fee, usually 1.5 to 2.5% of the committed capital. That keeps the lights on at the firm, regardless of performance.
Which is a nice, steady paycheck, but it is not where the real money is.
No, definitely not. Then, the LPs, the investors, get their original investment back, plus a preferred return, which is usually around 8%.
So the investors get fed first.
Until the hurdles are cleared. Once the investors are whole and have their 8%, we enter the carry zone, carried interest. The GPs typically take 20% of the profits, and this creates a very specific psychological structure known as a call option.
Let's break that down for you listening. A call option generally means you have the right to buy something at a fixed price, so your upside is unlimited. But if the price goes down, you just don't buy it. You don't lose anything other than the cost of the option.
That is the key insight here. Think about the risk profile for a fund manager. If I take a massive risk on a company and it pays off 10 to 1, I make a fortune. I get 20% of a huge upside.
But if you take a massive risk and crater the company,
I don't lose my own money, I just don't get my bonus. My downside is limited, but my upside is infinite.
which heavily incentivizes gambling.
It creates the asset substitution problem. And there is a theory discussed in the source material by Axelson and others called the fly-by-night condition. It suggests that bad managers, these fly-by-night operators, are actually more incentivized to take wild risks.
Because they have nothing to lose. If they play it safe, they are mediocre and get nothing. If they bet it all on black and win, they are heroes.
Exactly. They are swinging for the fences with other people's money. Now that is the baseline incentive structure. It is already skewed toward risk. But Deger's research looks at what happens when you add pressure to that mix, when a manager is specifically behind the curve.
And he identifies two distinct types of pressure in the data, right?
Yes. The first is the pressure to spend.
The dry powder problem.
Exactly. Private equity funds generally have a fixed lifespan, usually 10 years. And usually they have an investment period of maybe 5 years. If you are 4 years in and you still have 60% of your capital sitting in cash,
The clock is just screaming at you.
it is. Because if you don't invest that money, you have to return it to the investors. And if you return it unspent, good luck raising a sequel fund. You look incompetent. You look like you couldn't find a deal in a candy store.
So you have to put the money to work, even if there aren't any good deals to buy. Use it or lose it. That is pressure number one.
Pressure number 2 is performance pressure. This is when you have already invested in a few companies and they are doing poorly.
You are tracking for a low internal rate of return.
You are in the red. Now you are desperate for a home run. You need one massive winner to pull up the average of the entire portfolio so you can actually show your face to investors again.
So we have two desperate pilots here. One has too much fuel he needs to burn, which is the cash. The other is flying too low with bad returns. Let's look at what the data actually says they do. Let's start with that pressure to spend.
This is finding number 1. Deger looked at funds with a low capital invested ratio, meaning funds sitting on mountains of cash late in the game. And he found they consistently overpay for targets.
How big of an overpayment are we talking about? Like, what does the data show?
It is significant. The data shows that funds with low capital invested paid an entry multiple, that is the price relative to the company's earnings, that was roughly 9.7% higher than funds that were comfortably invested.
Nearly a 10% premium. That is huge in this world. If you are buying a company for $500 million, that is an extra $50 million you are just lighting on fire to win the bid.
It is the literal definition of panic buying. They aren't negotiating for value at that point. They're negotiating for speed.
Yeah.
They just need to clear the dashboard.
Now, my assumption would be, if they're overpaying by that much, they must be loading these companies up with debt to try and juice the returns. If I pay too much for the house, I need a bigger mortgage to make the math work on my equity.
You would think so.
Yeah.
That would be the purely financial optimization strategy. But this is where the data gets weird. These panic buyers actually use slightly less leverage than their relaxed peers.
Wait. They pay more for the asset but borrow less. That creates a terrible return on equity. You are crushing your own potential profits.
It absolutely destroys the returns. But you have to look at their motivation. Securing a complex, highly leveraged loan package takes a lot of time. It involves scrutiny from banks. It involves covenants. It involves deep negotiation. If your primary goal is just getting the money out the door before the deadline, you simply don't have time for that.
So they basically act like a cash buyer in a hot housing market. They just waive the equity check to close the deal quickly.
Precisely. They are optimizing for deployment, not for return. They are sacrificing the LP's potential profit just to say, look, we invested the money.
That is remarkably cynical. It is putting the firm's need to look busy ahead of the investor's need to make money.
It is pure survival. But it gets even darker when we look at the second group. The managers under pressure to perform.
Yeah.
The ones who are actually losing money.
The ones who need a miracle to save their track record.
This is where the asset substitution theory really shows its teeth. The data shows that poorly performing funds, those in the bottom quartile, are willing to pay a staggering 14.6% higher price for a company compared to top quartile funds.
14.6%. They are literally just throwing money at the target.
They are chasing high-risk, high-reward assets. They are paying top dollar for turnaround stories or volatile companies, just hoping for that 10x return that saves their reputation.
Okay, so if I'm chasing a 10x return, surely this is where I load up on leverage. If I am swinging for the fences, I need the biggest bat possible. I need maximum debt to amplify the equity return.
That is exactly what the call option theory predicts. They should bet the house. But this is the biggest surprise in Deger's dissertation. These desperate, poor-performing managers use significantly less debt.
Again, less debt.
16.1% less leverage than the top-performing funds.
It doesn't make any sense. If I am desperate to boost my returns, I need leverage. Leverage is the rocket fuel. Why aren't they using it?
Because they aren't allowed to.
Allowed by whom?
The banks. We have to remember there's another player in this game. The debt providers. They are the adult in the room here.
Ah, I see. The bank looks at the fund manager and actually sees the desperation.
Banks are rational actors. They see a manager with the track record of flops. They see a manager who is paying 15% over market value for a company, which means the collateral is inflated. And they say, no thanks.
We aren't giving you the credit card.
Or, we will only lend to you if you put up way more of your own equity to cushion our risk. The banking system essentially quarantines these bad managers.
That is a fascinating dynamic. The banks are acting as a built-in check and balance on the private equity industry's worst instincts.
It protects the bank, but it creates a death spiral for the fund. Think about the math here. The desperate manager overpays for the company, so the numerator in the ROI equation is high and uses less debt, meaning they have to use more equity, so the denominator is high.
Which drives the internal rate of return straight into the ground.
Exactly. They are trying to save the fund, but the market constraints force them into a deal structure that almost guarantees mediocrity. They are trying to pull up, but the engine power just isn't there.
And the flip side of this must be true for the winners.
The virtuous circle. This is the most damning part of the research if you are an underdog. The top quartile funds, the smart money, walk into the bank, and the doors just fly open.
The bank basically says, you guys are winners. Your last 3 deals paid off. Take as much cheap debt as you want.
So the top funds pay lower prices for companies. Because they aren't desperate, they can just walk away if the price is too high. And they get to use more leverage because the banks trust them.
Which boosts their returns even higher.
Success breeds success. But not necessarily because they are smarter investors in that specific moment. It is because the capital markets give them a cheaper cost of doing business.
It is the Matthew effect in action. To those who have, more will be given. It really makes you question the skill component of this whole industry. How much of that top-tier performance is actual genius, and how much is just having access to a credit line that your competitors simply don't have?
It raises a huge question about market efficiency. The system is fundamentally designed to amplify the advantage of the winners and handicap the losers.
I want to touch on one last variable here, which is reputation. We have been talking about funds like Fund 3, Fund 4, but what about the firm itself, the overall brand?
Right. The thought process being, if I am a KKR or a Blackstone or a Carlyle, a firm with 30 years of history, surely I get a pass if one of my funds is just having a bad year.
You would expect the bank to say, well, their current fund is down, but they have been giant since the 80s, so let's give them the loan based on the relationship.
That was hypothesis 3 in Deger's study, the reputation effect. He looked at firm age, total assets under management, total number of funds raised, basically all the metrics of old money.
And what did he find?
Statistically insignificant.
Really? The legacy advantage just doesn't exist.
Not in this specific context, no. The findings suggest that the debt market has a remarkably short memory. Banks and sellers really only care about your current fund. They care about your dry powder right now.
It is a total "what have you done for me lately" mindset.
Precisely. Being a 20-year-old firm doesn't stop you from panic buying if your current fund is underwater. And it definitely doesn't convince a bank to give you cheap leverage if your recent deals are flops. The pressure is immediate and local to the specific fund you're managing.
That completely shatters the idea that the big brands are insulated from these behavioral risks. They're just as susceptible to the nosedive as a brand new firm if they get behind the curve.
It keeps them honest, in a brutal sort of way. You are genuinely only as good as your current pool of capital.
So let's pull this all together for you listening. We started with the pilot, pulling back on the stick, stalling the plane out.
And we found that in private equity, that stall is a very real phenomenon. When funds have too much cash or too little performance, the managers basically stop optimizing for value and start optimizing for survival.
They pay premiums of nearly 15%. They rush headlong into deals.
But the safety net, or maybe it is more of a concrete wall, is the banking system. The banks refuse to finance the gamble, which forces the risk back onto the equity holders.
Which effectively neuters the gamble entirely. They pay a high price, but can't get the leverage to actually make that high price worth it.
It really is the worst of both worlds.
Which brings me to a final thought for you to chew on. We often see the headlines, "Firm X buys Company Y for a record-breaking price." And the usual reaction is, wow, that company must be incredibly valuable. The smart money says it is worth billions.
But after looking at this research, you have to ask an entirely different question. You have to check the background of the buyer.
Right. You have to ask, how old is the fund that bought it? Were they 5 years in with a massive pile of unspent cash? Were they just desperate to put points on the board?
Was that actually a strategic acquisition, or was that just a pilot nosing down to save the flight?
It completely changes how you read the financial news, doesn't it?
It certainly takes the shine off some of those record-breaking numbers. It strongly suggests that high prices might not indicate value, but rather the sheer desperation of the buyer.
That is a sobering thought to end on. Thanks for helping us unpack the numbers and the psychology behind them.
Always a pleasure to dig into the data with you.
And we will catch you on the next deep dive.